Okay, good afternoon and welcome back everyone to our Options Growth Lab series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to address probably what's on everyone's mind right now after what has been arguably a pretty volatile and difficult week in the markets to navigate all the different things that are currently going on. War is something that, generally speaking, you don't have a playbook for. So let's get into it and specifically talk about the pullback playbook. How do you buy a dip when everyone's panicking? How do you think about buying a dip in times of stress like this and a framework for that? So these sessions here are really focused on helping you to trade sustainably and confidently and providing you with a framework for how to navigate uncertain times like we are in right now. Now, what we are going to discuss here is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So the problem is that every single pullback feels like a bit of a crash, as to how far is it going to pull back, how violent is it, and when you don't have a plan, you generally freeze up or you panic and you sell in that type of volatility. And this is really because most traders don't have a particular process for how to manage each dip and think about whether or not it is time to be a buyer of equities or buyer of a specific underlying when things start to hit the fan. So, what I want to introduce today is a three-step filter that tells you exactly when sort of the fear has gone too far and a potential reversal is setting up and gives you that opportunity to buy the dip. Now, if you want access to the tools that I'll be showing you today, you can sign up for a free trial at optionsplay.com/signup. And you'll be able to get access to the tools, including the tracker that I'll be showing you here in 1 minute. That's going to help you also better get a context around what's currently going on in the Middle East. So I've been a strategist for 18 years, working with clients, both retail and institutional investors. I started my career actually trading in currencies and futures. But over the last 5 years, I've really spent a lot of time back testing, across the entire S&P 500 range of symbols using 25 plus years of data to identify these pullback opportunities and understand when you want to pull the trigger to be buying the dip. There isn't there isn't or rather there is a lot of uh, it's incredibly difficult to be objective when the markets are volatile and especially when things are driven based on geopolitical tensions or war, where there's very little visibility into what's going to happen. There's not necessarily a playbook for how this is all going to play out. So whenever you have a large amount of uncertainty that you have very little visibility into, it's extremely important to be objective in how you approach the markets. So, we're going to talk about objectivity from a trading strategy perspective, but I also wanted to provide a little bit of objectivity on what's currently going on in the Middle East. So we launched this de-escalation tracker a few days ago, and it gives you essentially a real-time tracking of a bunch of different things that, generally speaking, I think are worth paying attention to, given what's currently going on in the Middle East and what can give you a sense for when things are escalating, when things are de-escalating, and then summarize it into a red, yellow, and green phase system to give you a better sense for, are we in a state, in a phase where things are still deteriorating? Are things starting to stabilize? Are things starting to improve? And this morning, or rather pre-market, we were starting to see signs of stability. We've actually started to see signs of stability over the last couple of days. But today's price action, we're only, a couple of hours into the trading session today, and it looks like we are, teetering between stability and potentially going back into the red, where the four out of the five things that we're monitoring that triggered the upgrade to yellow, this morning we upgraded it to yellow, where we're saying essentially you can potentially start looking at establishing some small positions. Four out of the five things that triggered that actually reversed today. So, we're going to do another intraday update where we could potentially flip back into the red. So this is a systematic dashboard that allows you to monitor what's going on. You can see it inside of your OptionsPlay platform. If you go to your notifications, you can see this de-escalation tracker. It'll give you the framework, the summary of what's currently going on and what's triggered the upgrade to yellow. It'll give you a overview of what's currently going on with global markets in Asia and the Middle East. It'll give you gamma exposure in the S&P, and then looking at things like volatility, which is something we look at to gauge, the hedging demand from investors in the options market, looking at crude futures and the backwardation of those contracts, looking at freight rates, the cost of moving goods through the Middle East. And then one of the things that we're looking at is really airspace status. How are the major, and there are some major some of the busiest airports in the world are in the Middle East, how they are navigating the reopening of that. Those are usually good signs of whether tensions over there are continuing to escalate or potentially stabilizing or improving. So those are the things that we're looking at. And we give you a day-by-day breakdown of, what we're looking at, what the most important events are and how they've changed over time. So as I said earlier today, we upgraded it to yellow. However, based on four out of the five metrics that allowed us to upgrade it to a yellow have reversed intraday today. So this could potentially go back to red if over the next few hours we continue to see dealer hedging or gamma go flip back to the negative, which it did. VVIX is back up. VIX is back up. Oil is back above 80. So, like I said, there's a lot of things that are very fluid, and that's why we built this tracker to help you give you that better sense of what's actually going on and give you a overview of what's going on in the Middle East and kind of looking at the important data that'll help you gauge the situation over there, because there's just a lot of news out there. It's hard to synthesize all of that. So we built this tracker to help you better understand that. And that's available exclusively to OptionsPlay subscribers on our platform. So if you're watching this as a recording and you want access to this tracker, you can sign up for that free trial at optionsplay.com to access this de-escalation tracker. We're updating it multiple times a day to give you sort of a real-time monitor of what's currently going on over there. So let's go back to buying this dip, right? And this is really the part that's applicable to any dip, right? What the tracker itself is really only applicable to the current war in the Middle East. But when we talk about buying the dip overall, this is really where what I'm trying to show you is building that systematic approach to understanding pullbacks and defining when you can be a buyer in the markets. So what most traders do is trying to trying to buy the market after the bounce has already started. Now, this typically will give you a higher probability of success. It'll have generally a moderate risk to reward ratio because by definition, if you wait until the bounce is already in place, the risk to reward is just not going to be as strong because you are essentially waiting for the trend to be established before you jump on. So by definition, you are coming into it late. Um, It'll trigger multiple signals many times in a row, but they generally may not be as high quality. But the thing is that it feels comfortable. It feels comfortable to go with the trend, but you will miss some of the best entry points. Versus if you look at kind of when we backtest the strategy and try to understand when is the best time to be buying pullbacks here, what you want to do is you want to try to identify the point of maximum fear, meaning you want to be buying when everyone else is selling and no one else is buying. And that's a hard thing to do, but I'll show you some of the steps for how to try to identify that because that will give you, generally speaking, a lower probability of success, but a very strong risk to reward ratio. You'll have far fewer signals. Many times on many days, you won't see any signals, but each one's going to be high conviction. And this is something is going to generally feel quite uncomfortable, but this is really what the data is very clear on in terms of where the performance really is for buying a pullback. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. So essentially, this is applying the difference between following the trend and trading counter trend. It's the exact same thought process, but applying it to times of stress and times of market volatility. So you're just thinking of it's the same problem. You're just thinking about it in a slightly different context. And obviously, during a war is a context that we generally don't deal with on a daily basis. So the three-step pullback filter, how to find these exact entry points where the goal is to try to enter the trend at the very bottom, right? So here's a stock. It doesn't really matter what the stock is. It's trending lower, it's trending lower, it's trending lower. And at some point it starts to reverse that trend and starts trending in the opposite direction. And what we're trying to do is identify it as close to this bottom candle as possible. And with this exact method that I'm showing you today, there are many instances where you are able to identify it at that very bottom candle where I currently have that red arrow pointed to, as opposed to if you look at most technical indicators where you're looking at, some type of reversal, what they do is they try to they eventually catch it at maybe this candle, right? Sorry, they catch it at that candle. When you wait for a momentum indicator to reach its extreme and then generate that buy signal, generally that will happen maybe at this stage or somewhere up here. So you miss out on let's say this move, and what you're capturing is the further move. So again, it's the difference between following the trend versus trading counter trend. And the three-step framework is designed to help you identify stocks where you are as close to this candle as possible. And in many instances, you are actually able to pinpoint the exact candle where the stock reverses lower. So, first one, what we want to do is we want to measure the extreme move. Has fear pushed price to an unsustainable extreme? This is really where we use, instead of a single momentum indicator, most of us are familiar with using something like RSI or stochastics or William percent R or some type of momentum indicator. These momentum indicators are all very similar in nature. They have some of them have very different calculations, but they're all calculating the same thing, right? And if any of you have ever applied multiple of these indicators on your charts, you'll know that they all do very similar things, even though they might look a little different from each other. They're all trying to measure momentum and they oscillate around a zero line. Now, the challenge here is that those indicators, if you just use them in their classic textbook example, are not very good at identifying these types of, sorry, they can be good at identifying these types of trend reversals, but there's two problems with it. One, they tend to be relatively late to the game, so they'll identify it maybe right here or right here. So you miss out on that initial move. The second thing is that they also provide a fair amount of false signals. And they provide enough false signals where even though they're very good at identifying these types of setups, they also are very good at identifying plenty of setups that don't work out. And the performance, once you kind of average all of those good and bad trades together, essentially is very close to zero and sometimes slightly positive, slightly negative, but nothing strong enough to worth, using that as your primary strategy. So we have tried a lot of different indicators. We have tried a lot of different parameters for indicators, using 14 period RSI, 20 period RSI, 9 period RSI, 5 period RSI, trying it across all these different indicators, trying different combination of indicators. And there's only one thing that has consistently worked at identifying these price extremes that are worth evaluating further. And that is using the same indicator. So let's say use an RSI, using the same indicator, as opposed to using multiple indicators, I guess is what I'm trying to say, and using it across two vastly different time frames. So, for example, using a 5 period RSI and then using a 50 period RSI, or a 5 period RSI and a 40 period RSI, versus the standard RSI is usually a 14 period RSI. And so, for example, what we use is a 5 period and a 40 period RSI. And what you do is you take those two indicators and you average them out. So you take whatever the value of the 5 period RSI is, and you take the average, the value of the 40 period RSI, and you average the two. And only when the average of the two reaches a price extreme do you pull the trigger. And what you find is that when the average of a very short and a very long-term momentum indicator get averaged out, it takes a lot for that indicator to move into that extreme, right? Because it's really that long-term average that is much slower to adapt. So you need a really sustained move in one direction or another, not just a small move. And, that's generally what we would consider noise in the markets. It really takes a long sustained move in the markets. And then that short period RSI also has to be, which is a lot more volatile, also has to reach that extreme level. Those two things don't line up very often, and they only line up, generally speaking, when price is at a very steep extreme. So the stock has really dropped a lot in a very short period of time, and you have a much higher potential of that snapback, that mean reversion in the other direction. So the first thing we do is we measure the extreme in a very unique way, right? And this is not proprietary to us. I'm telling you exactly how I'm doing it. I'm being 100% transparent so that you can go and test it out yourself if you like. But take any indicator, you take one short, very, very short dated version of it, let's say a 5 period, and then one very long dated one, like a 50 period one, and then average those two values out. And only when the average reaches an extreme. So, for example, RSI, the quote unquote extreme is 30, right? If it goes below 30, you've reached an extreme. That's an opportunity to buy. So that's what we're seeing here on this particular chart, is that average has to reach that extreme in order to buy, to generate that buy signal. Now, that in itself will already generate a much higher probability of success. It generates far fewer false signals, that if you just traded that on an alone, you can get some pretty decent performance on these sort of extra pullback moves. However, I tend to find that you can use um, some further tools to help you even further filter out some false signals. And that is confirming the exhaustion, right? So, is there anything else that you can use to gauge whether that selling pressure is starting to fade? Are sellers getting exhausted? Now, I saw a couple of questions in the chat window saying, can you apply to a 5 and 50 minute chart? Can you use it any period, minutes, days, hours? Yes, I will. You can use it on any time frame. However, I will say, we've back tested them on the daily time frame, but you can use it on any other time frame. So the second step is you want to confirm that exhaustion. And what you typically do for that is just look for divergence on any normal indicator. You can use RSI, you can use MACD, you can use any normal indicator using a normal time frame. So for example, 14 period RSI, 20 period MACD, I'm sorry, 20 period stochastics, anything like that. And what you're looking for is divergence, right? Lower lows in price, that is not being confirmed by a lower low in momentum. When you have the price extreme measured using in sort of a unique way that I showed you before, and you have confirmation of that exhaustion, those two things alone will give you this pinpoint accuracy of potential optimal entry at the very bottom of a measured move. And the those two things alone will give you 95% of the work when it comes to measuring this type of price extreme. Now, I will say there is one third thing that I generally recommend most traders to do, and you don't have to do this in a specific way necessarily, but my suggestion to you is don't just buy anything blindly because you've got a system that has been back tested to be a profitable and proven strategy for identifying reversals. Meaning, if let's say you follow these rules and you find a stock that has reached these extreme moves, you find that a stock that has had um, the signs of exhaustion and that divergence between momentum, from my perspective, is good enough to potentially be buying that stock or that asset, whatever it is that triggers these specific rules. However, I always advocate that if you're going to be buying something on this type of basis, you should always have a basic sense for what you're buying. And that just typically can just mean a basic understanding of, if it's a company, like what's the name of the company? What does it do? What space does it operate in? Is it profitable? You don't necessarily have to do a deep dive into the fundamentals, but having a basic understanding of what the company, who the company is, what it does, how does it generate revenue, are they profitable, will many times get you out of just sticky situations because a lot of times common sense can just help you avoid some stupid trades. So, for example, um, um, let's say you identify a trading setup like this, right? And it's in an industry that just clearly is from a macro perspective struggling. I'm trying to think about a good one. So let's say over the last few months we've seen software stocks really struggle in this market environment, and there's a good macro reason for why software stocks are struggling. We've had some significant advancements in AI over the last couple of months that puts a lot of pressure on software companies that have a specific business model. And it's not yet clear as to one, if the market is necessarily overreacting. I definitely think there's some level of overreacting, but at the same time, the paintings, or what's the right terminology for this? The writings on the wall with regards to um, where uh, a purely SaaS-based software stock is headed in terms of valuation. So a basic scan of what a company does, what industry it's in, how does it generate revenue, is it profitable? A lot of times it's just common sense can prevent you from making some stupid trades. Most of the time you'll find that, the fundamentals will either be okay enough or won't contradict your views. But a lot of times when you dig into the fundamentals, there might be a reason why the stock is sold off so heavily in such a short period of time. And that reason is justifiable. And, if that were to be the case, that might be a reason to say, hey, even though technically speaking, we've satisfied all the rules for this particular pullback to buy. Fundamentally speaking, it just doesn't make sense. It doesn't feel right to be a buyer of a stock in this particular industry. I'm just giving you an example of software stocks, but you have to apply that level of common sense at the time to the market conditions that you're in, to get a better sense for whether or not fundamentally it makes sense. Okay, so that last part is probably the most subjective part of this. The first two steps are completely objective. There's no ifs or buts. Either it generates that extreme move and has exhaustion or it doesn't. The third part, in terms of validating the story, is going to be a little bit more subjective, but this is really where I'd say use common sense. Common sense will help you avoid some stupid trades if you just are familiar with what the company does, what industry does it operate in, and are you in a market environment that generally makes sense for it, right? Or are you trading against the tide from a bigger macro perspective? So why does this work? Really, one, it's about maximizing risk reward. You are buying at the point of maximum fear where everyone is selling and no one else wants to be buying. That's going to generate outperformance. You're essentially entering at the earliest possible point, and you're not waiting for everyone else to get in before you get into the trend. And this will generally result in much faster results. When you get into trades early, you will generally be able to get in and out much quicker, 30 to 40% quicker in your exit rather than being waiting for a move to already happen. Because once the move already happens, the subsequent move is going to not be as fast. It's not going to be as swift. So you're going to tend to be in a trade for a little bit longer as a result of that. So what I want to show you here now are the scans inside of OptionsPlay that automates these things that I'm showing you here. So inside of OptionsPlay, you have your trade ideas section, and under the trade ideas, you have technical ideas. So what I wanted to show you is how you can filter these technical ideas specifically for the setup that I'm showing you right now. So what you use here is you use the filters under technical setups. And right now we're only going to look at bullish ideas because we're talking about buying the dip, right? So buying the dip is obviously bullish ideas. And what we're going to do for the scan is we're only going to select the counter trend scan, because that's going to allow you to identify these exact price extremes that I'm talking about. And from my perspective, out of all the different indicators I've ever tested in the 18 plus years of my career, there's nothing that generates a real true counter trend setup that is that has a high enough return to justify using as a scan. It just there's no indicator, MACD, RSI, stochastic, CCI, none of them generate enough return on its own to justify buying every single time those indicators reach an extreme. Only when you're combining the two different time frames and averaging them out, and both time frames have reached such an extreme level that generates that buy signal, is it worth exploring. And so what I'm doing here is I'm going to also at the same time remove anything that's not liquid, because if we're trading options on it, right, it doesn't make sense for me to look at stocks where the options aren't very liquid. So I'm just going to filter that out at the very beginning, and that's going to help me immediately to filter down a few hundred ideas down to 28. So there are only 28 ideas. And if you want, you can also remove like small cap stocks. And kind of if you really want to just focus on some of the names that you're more likely to be familiar with. And as you can see, you have a list of 21 names. And I always like to sort these stocks based on relative strength because that gives me the list of stocks instead of in random order. It's sorted based on the weakest stocks at the top and the most strongest stocks at the bottom. So obviously for stocks that are oversold, they generally all have poor relative strength, but it just gives me a sense for how poor is that relative strength. The ones at the bottom, like I said, are the ones that are worse, right? So these are the ones that have sold off so heavily. These are in the bottom 10% in terms of performance in the markets. And a lot of times you find the most extreme moves out of that bag of trades. So I've already done some work here to look at some of these stocks. And I just want to show you a couple that I think are worth paying attention to here. So here's Whirlpool, right? This was a $93 stock that's traded all the way down to 59 in a matter of 2.5 weeks, right? So we're talking about a nearly 40% haircut in the stock price in just 40 weeks. I'm sorry, in just 3 weeks or so. And that's a pretty extreme move here to the downside. And that is the only move that would have triggered this particular extreme signal. And then on top of that, this isn't like the best negative divergence. But as you can see, this stock dropped all the way to 70, right? And theoretically, when it dropped down from 93 to 70 in the span of a week and a half, that would have been a strong enough move to trigger a counter trend signal, right? So that's a big enough move to potentially generate that. And certainly when it got all the way down to, let's say, 63 or so, that also would have probably been enough to generate that. But what you're starting to see here is that move from 70 to 60 is what started to get this negative divergence of the momentum, right? So we had already had an extreme move, but it kept moving lower. And as it kept moving lower, momentum started to move up as opposed to continuing to follow that. So those are the two things that I'm generally looking for to decide, is this a potential opportunity, right? Now, Whirlpool, I'm presuming most of you that live in North America or let's say you own a house are probably familiar with Whirlpool in terms of what they do. They make appliances. This is the stock that is, it's interesting from the perspective of, these durable goods overall have not been particularly strong. The consumer discretionary space has been a little bit weak in the last couple of months. It is trading at a very reasonable multiple, around 10 times forward earnings. But the company essentially is not profitable. It's not the most exciting trade to make, but it certainly has a lot of the hallmarks of a stock that is probably overreacted. I'm guessing the stock also reported earnings recently, which is why the stock is down so much, and could potentially be a bounce candidate. So this is really where you might have to do a little bit more homework on the stock itself to decide, is this a buying opportunity? But my goal is to help you identify, out of the thousands of stocks, just a handful of stocks that you might want to do a little bit more digging on to say which one is potentially worth buying at these extremes. And if you were able to, if let's say this stock does reverse, right, you're essentially catching it at the very bottom, right? So if this stock starts to reverse back into the $70, $80 range, you could probably see a snap back into that range within a couple of weeks, and you've bought it at the very bottom and capture that move here to the upside. So the goal here again is to help you capture these moves at that extreme so that you're not following the trend, you're essentially establishing the trend, right? Restoration Hardware, same thing. How do I get this to go away? There we go. Restoration Hardware. This is a $230 stock, $150 stock now, about a month later. This level that it's been at here in this 140 range has certainly been a pretty major support level multiple times over the last couple of last year or so. So you are potentially just also at just a, generally speaking, a major support level on top of that. And as you can see, just in the last couple of days, right? Whoops. This is really more so in just the last couple of days. You see this price move lower, but momentum is starting to move higher. So you have the early signs of also some exhaustion here from sellers. And if this thing starts to reverse lower, as you reverse higher here, as you see, what we're trying to capture it at is at that very extreme low, right? Buying it at that very bottom. So, then this means that instead of trying to research all these different stocks that are, quote unquote, undervalued, you are getting a very small short list of stocks that are worth exploring further, right? Restoration Hardware. Now, Restoration Hardware, operates in a call it an adjacent space to Whirlpool, right? You're buying furniture, expensive furniture for your house if you're shopping at Restoration Hardware, and it's trading at 14 times forward earnings. It's not particularly profitable. It's actually, net margins are 3%. Nothing really exciting about it. Revenue growth isn't, EPS and revenue growth is EPS growth actually looks pretty strong, but it's coming off of a really low base, so not particularly that exciting either, in my opinion. But it gives you a much smaller short list to really research from a fundamental perspective. Another one I want to take a look at here is Novo Nordisk. So we're probably all familiar with the the weight loss drugs, and these stocks have really gotten punished recently. So this was a $65 stock in the beginning of January, traded all the way down to $36, essentially half the price in about a month, a little over a month. And it's triggered this sell signal here again. I'm sorry, this buy signal, a counter trend buy signal. And here you go. You've got that classic setup here, right? So we're not quite at the bottom, right? We're just two candles away from the bottom. And I think this is a prime setup potentially for a move higher here. And this is probably, a classic, uh, market sort of overreacting to, what is obviously a very, what's the right word? Public price competition fight right now between multiple drug companies that all have similar drugs, and these weight loss drugs, and they've had to, what was at one point a extremely profitable franchise has now turned to a very bitter price war on who's going to undercut who in terms of pricing on these weight loss drugs. So the stock has taken a big hit here in the last year, but certainly very much so in the last month. It is trading at now only 11 times forward earnings, which is substantially lower than where it was trading at just a couple of months ago. But it is extremely profitable. 33% profit margins. We're talking about EPS and revenue growth that's in the 20-25% range, yet it trades at 11 times forward earnings. I think this looks like a very compelling setup from a trading perspective, because you've got a stock that's trading at, rock bottom valuations because of the price wars, yet it's still incredibly profitable. It's still growing very fast. And this helps you identify when to be a buyer at the very bottom and hopefully capture what could be a sizable move in a short period of time using this tool. And the goal here is to, again, reduce the number of stocks that you have to do that type of research for, because doing that fundamental research takes probably the most amount of time. You have to understand the company, you have to understand what it does, how profitable is it, how fast is it growing. Those are some of the basic things that I'd be looking at trying to understand. And I think people's desire to lose weight is not going to go away because of war or you know geopolitical tensions or macro tensions. So for those reasons, I think this is out of all the things that we've looked at, the three different trades we look at, probably the one that looks most promising. And that's really where I would turn to options play to help me structure an options trade. Try to structure something like a buying a call vertical where I can potentially risk $378 to make $622 if the stock gets back up to 45, which is where it was just a few days ago, right? So if we get that mean reversion back to 45, I'm risking 370 to make 622. Those are the types of setups that I'd be looking for, and maybe even looking at being a little bit more aggressive, maybe doing something like this where I'm buying a 140/50, 40 by 45 vertical, risking 130 to make 370. So, with these counter trend setups, I'm many times more inclined to take a more aggressive approach when it comes to my strategy because these are lower probability of success, but when they are successful, you want to capture, at least a 2 to 1, closer to 3 to 1 would be a better trade in my opinion. And you're getting very close to 3 to 1 on this trade if you were to buy that May 40/45 vertical. I actually think that you may not even need to go out to May. You could probably even look at the Aprils. And now, as you can see, April, you're looking at nearly 4 to 1, right? That still gives you 43 days. I don't think you even need 43 days to get there. So for those of you that are even more aggressive, you might even say, you know what, I'll take a gamble here on maybe a weekly option 28 days out. I'll buy that 40/45. This will give me nearly 5 to 1 risk to reward ratio. So, there are the thing about options is that you have a lot of options, and it's really just about understanding when you want to be more aggressive and when you want to be more conservative. And with trades like this, where you're trying to catch that bottom, those are the times when you want to be more aggressive, buying shorter dated, slightly out of the money call options or a vertical like that. Those are the opportunities that give you the potential to get a 4 to 1, maybe even a 5 to 1 risk reward ratio, something that you don't come across every single day because you don't come across trades like this every single day, where a tier one franchise in a pharmaceutical stock gets so oversold that you have this buying opportunity. Those don't come around very often. But when they do, that's when you do want to take that more aggressive option strategy where you're buying shorter dated, further out of the money call options, and you're trying to hit a home run. So that's kind of how you find these setups. And this is how we help you find these opportunities. And I'll just quickly review how you find these opportunities one more time. Under the trade ideas section of Options Play, you have technical ideas. And what we do is we filter those technical ideas for bullish counter trend, right? So bullish counter trend is really what you're looking for. Now, oh, sorry. I don't know why I got logged out there. I will walk you through that here one more time. 1 second. So I'll walk you through. So as you can see, we have 367 trade ideas today, right? So we're going to filter this out. We're going to only look at bullish ideas, or we're going to only look at counter trend, and I'm going to remove everything that's not liquid. So that gets me down from 357 to just 28. You can go even further by saying removing small caps. So now I'm down to 21, right? And like I said, my suggestion to you is sort based on relative strength. And with these types of counter trend setups, I like to start with the weakest stocks first, the ones that have a score of 1. Those are the ones that have been just so oversold. They're in the bottom 10%. They generally have a higher probability of that mean reversion trade and start there, right? So I basically went through this. And as you can see, I just did it before this session so that I didn't have to look through it one by one with you guys. But as you can see, within the first what is it, 6 or 7 symbols, I was able to find 3 of them that met that the trading criteria that I was talking about. And out of the 3, the one that I liked the most from a fundamental perspective was Novo Nordisk. So I kind of just use that as an example. But that's the process by which you can identify and find these types of setups and 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 um, and replicate them on your own. But like I said, once you do find those types of setups, and they don't come very often, and there are some days that you go through this process and you don't find any. That happens quite often when you're trying to find these counter trend setups. But when they do, that is when you can modify these strategies to be a lot more aggressive, buying shorter dated options, looking at buying slightly out of the money call options. As you can see right now in Novo Nordisk, if you bought that April 2nd 40 by 45 call vertical, you're getting a 90 by 410. So you're getting more than a 4-to-1 risk reward ratio, maybe 4.5-to-1 risk reward ratio on a trade like this. So we can even add this to our Growth Lab portfolio. I'll add it to our Growth Lab portfolio here. Actually, before I added it, I should have used my risk and investment calculator, calculated the appropriate number of contracts for me, which is $2,000 that I want to risk. That means that I can buy 22 contracts of these. So that's risking $1,980. Now, because I already added one contract in there, I'm just going to reduce it down to 21 and I'll add this trade back to my Growth Lab portfolio so that we can track this. You guys can track this as well. So the Growth Lab portfolio is a public portfolio available to you under the portfolio section, um, so that you guys can track this trade over the next few days and see how it performs. So there is that Novo Nordisk position here. This is a public portfolio that anyone can see, and you can see that position here. And over the next 20 days, you'll see how this 90-cent portfolio, a 90-cent call option that we purchased, how that'll perform, so that you guys can all take a look at it together. And with that, that covers what I wanted to share with you here today. So you're a pullback playbook. You want to try to identify when most traders, um, uh, you know, you want to make sure that you have a set process for identifying these dip opportunities because most of them fail, right? It's only this three-step pullback filter that has been proven and back tested to identify which dips are worth buying and which dips are ones that you should avoid. And the vast majority of them are ones you should avoid. And hopefully what I showed you here today is how you can automate it using your OptionsPlay platform. So if you want access to the platform that I showed you, if you want access to the scans, if you want access to that Middle East war tracker, this is all available to you at optionsplay.com. So you can sign up at optionsplay.com/sign up for a free trial to access everything and test it out for yourself. With that, let's open it up for Q&A so that you can type your questions into the Q&A window, and I'll try to answer your questions in that session. Hey Tony, is it wise to do a credit spread during an earnings report? Not really relevant to what we're talking about here, but Stephen, generally speaking, a credit spread is a short volatility strategy, and earnings is, volatility will collapse after an earnings announcement. So generally speaking, it is a suitable strategy for earnings. It is also limited risk, which is why it makes it suitable for earnings. So the short answer to your question is yes, credit spreads are a suitable strategy for trading earnings. Steven is saying, doesn't the 5 and 50 period CCI do the same thing? It measures the same thing, but measures it over two very vastly different time frames. And you need to have the price extreme be on both levels at the same time for this to generate a strong performance in terms of strategy. So yes, it does the same thing, but because it's over two vastly different time frames, it sort of doesn't do the same thing at the same time. Hope that answers your question. Mark is saying in a previous video you had used 5 and 50. I believe today you mentioned 4 and 50. Yes, so we have both 5 and 50 and 4 and 50 have nearly identical results. We've tested both. We've tested everything, right? We've tested 10, 20, 30, 40, 50, 60, and more. We tend to find that 40 to 50 is that sweet spot. The 40 to 50, performance between those two numbers are almost identical. So we actually use 40 in our algorithms for triggering these signals. But if you use 50, you would see nearly identical results. Mohammed, your suggestion of using more longer term suggestions in the daily play, thank you for that feedback. It's definitely something that we have continued to explore is actually expanding the types of trades that we publish in our daily plays. So, we've already expanded our daily plays to cover at least, potentially two, if not three different types of trades each day. We're also looking at expanding it even more to longer dated options and then even shorter dated options as well. So thank you for that feedback, but we definitely are considering that. Um, would you, this is a good question. This was a question about the couple of trades, right? Would you consider selling premium or buying a bull call spread? I mean, so essentially, would you trade a credit spread or a debit spread for this type of strategy? And it's a really great question. From my perspective, when you're trading counter trend, you're expecting a quick, fast move in a short period of time, and you're expecting that stock to make and by definition, when you expect something to make a quick move in a short period of time, the best strategy for that is going to be a debit spread. You can trade a credit spread, but you're just going to have a negative risk reward ratio, which is not quite suitable for this type of setup, right? These setups don't come along very often, and when they do, they tend to be really good setups. So these are the times that you want to reserve for buying a debit spread, not just selling a credit spread. I know the rewards are less, but isn't it better to buy spreads in the money? So, the thing about options is that there are a lot of options, and one option is not better than the other. It's just each option has its unique characteristics that are suitable for different scenarios and different risk profiles. So, for example, if you prefer to have lower risk, more balance between risk and reward, where you have a higher probability of success, but you're not going to hit home runs, but you're going to have more singles and doubles, then yes, an in the money spread is going to make more sense for those types of setups. When we're looking at out of the money spreads, like the one I showed you here in Novo Nordisk, you're going to have lower probability of success, but you're going to get 4-to-1, 5-to-1 risk reward ratio, which you're not going to get very often. So the nature of the the nature of the trading strategy that we're talking about here is high probability, big move in a short period of time. Those are the characteristics that you get with these types of setups, which is why this is one of the few times I would advocate for these short dated out of the money call options or call spreads, because that is when you can really monetize it or have a high probability of monetizing those types of out of the money call spreads. Otherwise, I'm generally more of a fan of buying an at the money or slightly in the money debit spread. So this is a really good question. Charles is asking, can you give us an example of how you set your indicators to see the average of that 5 and 50, CCR RSI method you mentioned? And unfortunately, you can't do that. No charting package, as far as I have seen, allows you to do that other than if you were to write your own custom indicator uh, using a platform that uses an open source language. So that could be TradingView with their Pine script or Thinkorswim with ThinkScript. And I've actually, if you go back in the YouTube channel at OptionsPlay, if you go back, I have actually done a video where I've shown you how to use ChatGPT to write this exact indicator. The average between the 5 period and 50 period RSI. And take ChatGPT, have it write a custom indicator for you, and then you can add it to your chart in either Thinkorswim or TradingView, and that's the only way. You can't in a standard charting package. Averaging out two indicators into one single indicator is just not a feature of any charting package that I've seen. So the only way to do it is to build it yourself. And these days with ChatGPT, you can have ChatGPT write that code for you and just import it into, like I said, your TradingView or your Thinkorswim. So I actually have a video that I've done on exactly that in our YouTube channel. And just to sort of reiterate that um give me 1 second. I'm just there's a couple of things that I'm looking for. One, I'm trying to see if I can even find that video. I think this is the one that I'm talking about here. Yep. So here, I'll share this link. This is the link of that video that I'm talking about. But it's this video was done over a year ago, and what's really interesting is just how much the market has evolved since then from an AI perspective. That I just did a webinar about 2 weeks ago. Yeah, 2 weeks ago, where I showed you how we used the latest version of Claude and automated, essentially what is a, $300,000 equity analyst job using about roughly $2 worth of compute power to do so. And just how far AI has come in the last couple of years. That and Most of it has actually accelerated in just the last couple of weeks. We just recently published our latest AI research, and we believe structurally that the market is severely underestimating AI compute demand by orders of magnitude. And we think this is probably the biggest opportunity in the markets here right now. So for those of you that are OptionsPlay members, you've already got access to this research that we just published on Monday morning. This following Monday, the one that's just coming up, I'm going to be releasing the second piece of this AI infrastructure research, where we're going to be doing a deep dive into the semiconductor industry and my what I feel are the best opportunities within there. In this macro research piece, I've already identified my top AI stock pick. So for those of you that are members, you'll have already gotten access to the report that we just showed you on Monday. But this upcoming Monday, if you aren't a subscriber yet, if you want to have access to this research, please consider subscribing, because I'm going to be releasing the second tranche of this research, where we're going to be showing you the semiconductor industry. And that is a very interesting and quickly evolving space as well. Even though there's been a lot of volatility, a lot of concern in that particular space, this is really where I think a lot of the immediate gains out of AI is going to be coming, is in the semiconductor space. So I'll be releasing that on Monday as well. And if you watch that video from a couple of weeks ago, where I showed you how far AI has come in the last few weeks, things are evolving so fast that, this thesis all came about, with essentially just a few product launches that came out about a month ago that just completely changed the capabilities of AI, and completely changed the compute demands that we're going to require out of AI, from just answering basic questions to now having them do complex tasks that, sometimes could take 10, 15 minutes, maybe even up to an hour, a few hours of work. and they're just constantly churning through compute in the background. And that is what Wall Street has not modeled correctly for, and that's why I think this is the biggest opportunity of our generation. With that, I think that's a good place for us to end for today. Like I said, I hope this is helpful in giving you a better understanding of how to identify the best trading setups when you're buying the dip. Hopefully, our Middle East tracker is helping you navigate through all the noise that's currently happening here in the Middle East. Let us know what your feedback is on that. And then please join me on Monday morning where I'll be releasing the second tranche of our AI research, doing a deep dive into the semiconductor industry. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.